If most of your net worth is tied up in a single stock, you're not investing, you're gambling. Here's how to protect yourself without panicking. I'm Grady Cool, CEO of Cool Wealth Management. You worked hard to build up your investments. Let's make sure you don't lose them. What is a concentrated position? This is when you have a ton of your net worth tied up into one company. For example, if I had worked at Amazon and then gotten a bunch of Amazon stock from working there and 30% of my net worth was tied up in Amazon, that would be a concentrated position. Can be more extreme, less extreme for some people depending on how long they've worked there and the nature of how far up the food chain they are. But it is dangerous to have too much of your stock all in one place. Let's talk about some of the most common ways people end up with concentrated stock positions. The first one and most obvious is working at a big company and being given either stocks options, restricted units, or some sort of stock compensation. Frequently, people aren't making a ton of money when they start getting these things, but the stock is how they're supposed to make a ton of money. So it becomes a large part of their overall net worth. The other situation is if you're working at a very small business, might be you own the whole thing, that's a very concentrated position. Or if you are one of the first few people to start working there, and when you came to the company, you got buy-in for part of it, let's say 10-20% of the business you just straight up own, that's usually going to be quite a substantial part of your net worth. Now let's talk about why it's dangerous. There's the logical side and the emotional side. Logically speaking, having that much of your money in one company, especially if you work there as well, if that company does poorly, your entire net worth could be going up in flames. Not to say that you would have absolutely nothing. Your net worth could be cut in half or 75%. We have seen plenty of massive companies go under because of just some scandal completely out of employees' control. Then there's the emotional side. When you have that much of your net worth in a company that you work at or you are very emotionally attached to, it becomes much more difficult to sell some of it, especially once you have a lot of it. You feel like it's an active decision you've made to bet some of your life on that company. This can be even more so if you really believe in the cause or the person who runs it. That makes it hard to make good decisions. Emotion and money decisions, they don't always go together real well. Now, you do have to consider your goals and how to deal with that stock position, but the emotional side of it can be really hard to deal with if you end up losing a large part in that position. Your entire net worth going up in flames and you feeling like it's all your fault. Now for the big question you have all been waiting for patiently this entire video, which again, thank you for that, is how do you actually handle a concentrated stock position? Honestly, it really depends what your goal is. If you're working at a company and you feel quite passionately about being able to enjoy some of the treasures of working at that company, yes, you can hold some of the positions still. Instead of having a fully concentrated position, you can just have some of it, which leads to the question of how do we get rid of some of it without getting tons of taxes in the process of all the capital gains. You can sell it piece by piece while not moving your tax bracket up. For example, if you make $90,000 per year and the next tax bracket is at $100,000 per year, you might sell off $8,000 or $9,000 of your concentrated position that year so that you don't get taxed at a higher marginal bracket overall for your taxes. If you are dead set on keeping the position, but you do want to deal with some of the risk, one thing you can do is options. While you have your position, you can buy put contracts on it. So if the price goes down in value, you get to basically earn that same amount back. The one issue with this is options contracts can get expensive if used over a longer period. This is a better option if you're doing this in more the short to intermediate term. Let's say that you are an executive at a big firm like Microsoft and you want to work there for the next 2 to 4 years. That's a period over which options contracts might make sense. If you're there and you're 30 and plan on working there until you're 60, might not be such a good option at that point. Figuring out which plan of attack for either selling part of your position or using other means to deal with some of the risk is something that you have to be careful with in order to not trigger unnecessary taxes or to get rid of a whole bunch of potential gains in the process. How to handle a concentrated stock position can definitely be tricky when you're looking at all these different options. So definitely, if you need some help, let me know down in the comment section. I'm happy to look at your situation and be able to provide some sort of solution. Otherwise, if you're looking at your own situation, how would you deal with a concentrated stock position for your goal?